Hi, and thanks for watching episode 4 of our Trader series. My name is Vincent and I work at Maven. Today I would like to speak about stocks. As you can see, stocks falls in a category of equity. And the first thing I'd like to explain is the difference between debt and equity with the help of a little example. So let's say a business owner thinks of raising money to expand her business. Let's say she needs $100,000. Well, she can either go to a bank and ask for a loan, but the bank will ask in return some sort of annual interest payment. We will classify this as debt or fixed income. Fixed income is kind of more a financial term, and you can imagine that as long as she has this agreement with the bank, every year she has to pay 5% in this example, 5%, 5%. So the income for the bank is kind of fixed. The other way she can raise money is to go to maybe a private investor and says, well, can you give me $100,000? And in return you get an X percentage of my company. So the investor gets a stake in her company. We would classify that as equity. So the private investor gets stocks. The dynamics work a bit different. Let's say the business does very well, then the bank doesn't really care because the bank gets just 5% no matter what happens. And the investor will be maybe very happy because the 10% stake in the company, or whatever percentage it is, will grow as the business of the business owner will grow as well. On the downside, it works different as well. Let's say the business owner does not well at all. The firm is almost bankrupt. Then the stake of the private investor will kind of diminish almost to zero. And the bank does still get 5%, 5%. But when things go really downhill and there's only small money left, and both the bank and the private investor are kind of begging for whatever money is left in the bankruptcy, in that case, the bank gets money back first. And only after, if there's still money left, the private investor. So you might now understand that debt as a category is a safer investment than the equity part. The equity part has the unlimited upside. If her business does very well, the 10% stake will also just go to infinity. But on the downside, if the company does very poorly, well, the stake will be worth almost zero, whereas the bank still doesn't care. So debt and fixed income is a much safer investment than the equity part. Okay, talking about stocks. Private companies can raise money to go public. They can actually go to an exchange and raise cash through the public by doing an IPO. You must have heard about this term by now, initial public offerings. So the company itself is supported by investment banks, and they decide how many shares are we going to sell to the public and for what price. And these investment banks, they have big clients, and they try to kind of get a sense of what these clients kind of find the value of this particular business and how much they're willing to pay for it. Retail investors, like myself and like yourself, typically buy the shares later. So first has kind of a public offering started only for the clients of the investment banks. And only after, kind of in a sort of a second round, you and I are able to invest in this company. To give an example, there's a tendency for underpricing, and that could be bad for the company itself that's going to get listed. For example, LinkedIn went public at a price of $45 a share, so basically in the first round. And when the second round arrives, there was so big an oversubscription that people like you and I were just piling into LinkedIn because we like the stock so much. And the stock price went from 45 to 145 on the same day. And later on, the company got taken over by Microsoft for 196. So you can see LinkedIn left some money on the table there. They sold their share for $45, whereas actually the same day it traded 145. So there's a tendency for underpricing, which can be potentially, well, not damaging, but they could have got at a better price. Also, I'd like you to understand a bit the concept of short selling, because some of you might only consider you are able to sell a share if you possess it. But the whole concept of short selling is that you're able to sell a stock that you do not possess, which is a bit of a strange dynamic. But how it works in short, it's a bit along the following lines. Big funds, like pension funds and hedge funds, they just own a lot of stocks by default. And they will park their stocks at a custodian bank, as what we call it. And these custodians then are sitting on this large pool of stocks. And now what you can do, or what I can do if I want to, I can kind of borrow a stock from this custodian bank. Now I have actually, technically, I have this stock, and I can sell it in the market. So that's what I can do. And why would I do that? To anticipate, let's say I borrow the stock from someone else, I'm selling it in the market. Now I'm anticipating the stock goes down, that it falls. I can buy it back lower, that's why I make a profit. And now I have the stock back and I can return to the custodian bank. That's how the technicals work. Now there are a couple of caveats. Short selling comes with carry costs. First of all, I'm borrowing the stock from the custodian bank. That comes with borrow costs. So each day, each week, each quarter, I have to pay a small fee because of the fact I borrowed this stock. And also, I need to make some interest payments to a margin account. And how that works is that if you short a stock, the stock can only go to zero, that's your best case scenario, but it can fly up to infinity. Right? So if the stock, instead of going down, meanwhile going up, 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 you mark yourself a paper loss. And that loss you're already writing there, you need to kind of be able to show your broker that you are able to cover that. So if the position goes against you, you have to be able to post money in your margin account, which again comes at a cost. So in short, short selling comes with considerable risks. Short squeezes are kind of well known, and short selling bends are also sometimes there. Sometimes the circumstances are so stressed that the authorities will say, from now on, you cannot short stocks anymore. And if that's the case, all people who are already shorting stocks have to buy it back. And that will cause a short squeeze. Well, most of you know the story about GameStop, which was a short squeeze in itself. You can see in a short time frame, an irrational spike up in the stock that has nothing to do with the company itself. It's just the fearless dynamics of this whole short selling structure. All right. Especially in Europe, there are two types of classes of shares. One type is the ordinary class of share, and the other one is the preferred or the preference sort of shares. The ordinary ones, they carry voting rights. So typically the founders of a particular company, they own mostly the ordinary shares. And the preferred shares, the preference shares, they kind of rank above the other shares in terms of a dividend. A dividend is kind of a part of the profit a company kind of gives back every year or every quarter to the investors. And these preferred shares, they kind of pay a dividend, mostly more or maybe at all above the ordinary shares. So as such, you can maybe understand that the preferred shares are designed for the public. The public is interested in actually getting a dividend out of the investment, whereas the ordinary shares are more meant for the founders. And the reason why this dual class system was invented, it's very common in Germany, is to kind of protect the founders for hostile takeovers. So that the ordinary shares, they carry the voting rights. And typically the ordinary shares, some of them are traded in the market, but often the majority is still owned by the original founders, that they can have kind of a say in what's going to happen in the company. As I said, sometimes both the preferred and the ordinary shares are traded on an exchange. Volkswagen is a very good example. The VOW3 is the preferred share, and just the VOW is the ordinary shares. And you can look it up. A unique event in history caused the spread, the difference between the ordinary stock and the preferred stock to divert a lot, which shouldn't be happening because it's the same company, and obviously this is the difference between the both share classes. It's kind of stable, but a unique event caused the ordinary shares to kind of divert and the preferred shares to stay behind. And a lot of investors and trading firms try to play this game by shorting the blue one, the ordinary shares, and buying the pink one. And why? They were anticipating that the difference between the two share classes would revert back. And it didn't happen because there was a whole story behind it. And that can become kind of a dangerous and costly approach. So as I told before, both the carry costs and also some sort of corporate actions that can happen, in this case in Volkswagen, can make this pairs trading, as we would call it, quite an expensive exercise and very dangerous, with only limited upside. Because, I mean, the best case for them is that the gap comes close to where it was before, whereas this gap can just divert to any irrational number, and it makes people to lose quite some money. Okay, the last sheet which I have for you is that I want you to be aware of ADRs, American Depositary Receipts. These are kind of certificates, and they behave like actual stocks. They are listed in the US. And they are expressed in dollars. So for example, Barclays, which is an UK company, there's an ADR listing on it. So this allows US investors to be invested in an easy way in UK stocks, Barclays in this particular example. So they behave in tandem with the local listing, the actual Barclays stock. And generally they're much less liquid, they're trading less frequently. And you can imagine that Barclays, the stock Barclays, is traded much more often in the UK than it is in the US. And the interesting part is that the euro-dollar exchange rate plays a role. Well, in my example, the pound US dollar rate plays a role, which causes some variance. These are two snapshots. The top one is the actual local listing of Barclays. It's trading 146 pennies. And this is the actual ADR listed on the NYSE in New York. And they traded hand in hand. You see a difference in price, but that's because there's an exchange rate involved, as I said before, and there's kind of a multiplier involved. So if you do the math correctly, then it will add up quite nicely. Can you trade those two against each other? Yes, you can, but again, there are costs attached if you want to convert this position into this position and the other way around. So, in summary, equity refers to a stake in a business, whereas debt or fixed income refers to just a loan. Stocks can be sold short, but typically it's a dangerous operation. And US citizens can get exposure in non-US listings through ADRs. Well, hopefully this gave some insight into stocks. Stay tuned for more episodes.